All right, let's talk about American Outdoor Brands, ticker AOUT. After they reported earnings back on September 4th, the stock it fell off a cliff. So what happened? We're going to unpack the whole thing, the numbers, what management said, and why the market got so spooked. It's a fascinating story.
So get this. The stock closes the day totally normal at $10.33. Then the earnings report drops. And in after-hours trading, bam, it plummets all the way down to $8.48. We're talking an 18.5% drop, just a complete nosedive.
So the big question is, right? What on earth could have spooked investors that badly? Was it just a simple case of bad numbers, or is there something deeper, something more complex going on here? Well, let's dig in and find out.
Okay, to really get what's happening, you have to understand that there are two competing stories here. You've got the hard, cold numbers on one side, and then you have the narrative that the company's management is pushing. And believe me, they are very, very different. And yeah, look, on the surface, these numbers are not great. They're just plain ugly. Revenue came in at $29.7 million. The street was looking for something closer to $36 million. That is a huge miss. And then you look at earnings per share. They miss there too. A miss on both the top and bottom line, that's almost always going to get a bad reaction from the market. But here's where it gets interesting. While everyone else is hitting the panic button, the CEO, Brian Murphy, he sounds totally calm. He basically says, hey, we've been here before. This feels a lot like fiscal year 23, and we proved then that our model works. It's a really confident, almost defiant tone. He's telling the world, you're looking at the wrong thing. Those numbers, they don't tell the whole story.
So if the headline numbers aren't the real story, then what is? Well, according to management, the answer can be summed up in one word: tariffs. It's all about how their retail partners reacted to the threat of new tariffs.
And this is the key number right here, $10 million. Management's argument is that about $10 million worth of orders that should have been in this quarter's results, well, they weren't. They got pulled forward into the previous quarter. Why? Because retailers were scrambling to buy inventory before potential price hikes from new tariffs kicked in.
And just look at the difference that makes. The reported sales number shows a terrifying 28.7% drop compared to last year. Yikes. But if you mentally add that $10 million back in, the picture totally changes. Now it's only a 4.7% decline. That's a radically different story. So management's whole point is, look, this isn't a demand problem, it's just a timing problem.
And to prove their point, they kept talking about their point of sale, or POS performance. Now, all that means is what's actually selling to you and me at the checkout counter. It's a measure of real, on-the-ground consumer demand. And what management said was, our stuff is selling better at the register than our competitors. The subtext there is, the end consumer is still showing up. Okay, so besides that whole tariff story, management also pointed to some real bright spots in the business. These are the kinds of underlying strengths that they believe support their optimism, even if the market completely ignored them in that initial panic. And you know what? There really were some undeniable strengths here. Gross margins actually went up to almost 47%. That's fantastic. Their balance sheet, rock solid. We're talking nearly $18 million in cash and absolutely no debt. And get this, new products made up almost a third of their sales. That's huge. Plus, they even bought back $2.5 million of their own stock. You don't do these things if your company is in real trouble. So that begs the question, right? If you've got all these bright spots in a pretty believable explanation for the bad headline number, why did the stock get hammered by 18.5%? Well, the answer, my friends, is in the guidance. This right here, this is what killed the stock. Management came out and said they expect sales in the next quarter to be down about 15% year over year. Think about that. After spending all this time explaining that the last quarter was just a timing issue, they turn around and forecast another big drop. For investors who absolutely despise uncertainty, this was the nail in the coffin. It just signaled that the choppiness isn't over yet. So this really brings it all together. It's truly a tale of two stories. On one hand, you've got management's story. POS is strong, innovation is working, our margins are expanding, and this was all just a wacky timing thing. But then you have the market's reality, a huge miss on revenue, really weak guidance for Q2, and a whole lot of uncertainty. It's those two conflicting narratives battling it out, and right now, the market's story is winning. All right, so where does that leave us as analysts? Our job is to cut through all this noise and figure out which story is more likely to be right in the long run. So let's get to it. Here's what we think you should be watching, and here's our official rating on the stock. We're watching three big things. First, tariffs, obviously. Any resolution there, one way or the other, is going to be huge. Second, the holiday season. Management says POS is strong, okay, prove it. The holidays will be the ultimate test. And third, a really interesting one is a new product called SCORETRACKER Live coming next spring. If that launch goes well, it could create a whole new recurring revenue stream, which would be a total game changer for the company. So here it is, the next call from us here at Talk Tickers. For Q2 revenue, we actually think they're going to beat that negative 15% guidance. Why? Because management set the bar incredibly low. It feels like an easy hurdle to clear. For the stock price, though, we see it being stuck in a range for the next 6 months, probably between $9 and $11.50. The market is just going to be in wait-and-see mode. And all of that leads us to our final rating. Market perform. The company's fundamentals are actually pretty strong, but you just can't ignore the massive near-term uncertainty around revenue.
And of course, we always have to say it. This analysis is for informational purposes only. It is definitely not financial advice.